Welcome back. Earlier in the show, our financial expert, Bruce Sellery, shared some really important tips about finding your financial footing during such uncertain times as these. Now he is back to answer your specific questions. Bruce, we're going to start with Gail, who has a question about joint accounts.
Hi, Bruce. I'm wondering about accounts and couples. Is it better for couples to come together and have a joint bank account, or is it more beneficial for couples to keep their bank accounts separate? Thanks.
It's a great question. There is no right way. There's actually three options. There's joint account, keep it separate, and then kind of a hybrid where you've got your money, my money, and our money. I would consider your temperament. So in some couples, having some privacy and some sense of control over your money is a really important thing. If one of the people in the couple is a spender, they may want to have access. It's like, this is my money. It's not the whole family income, but it's $200 a month, $500 a month, whatever it is. That can really make sense. Here are the three principles that I would apply. First is, whatever you do, whatever method you choose, focus on shared goals. So you're both on the same page, working for the same thing. Second is simple, 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 simple. So anything that you can automate on savings or bill payments or all those kinds of things that recur every month, do that. And the third, whatever method you choose, as a couple, make sure you communicate. Because you might start off one way, talk it through, and be like, now we need to change it because we've got kids or we've got whatever it is. So keep the lines of communication open. Don't have that kind of practical question of how you organize your money be a source of strain in your relationship.
Good answer there, Bruce. Okay, Chris sent in a question for you as well. Here's what he asked about investing.
Hi Bruce, my investment horizon is about 15 years. How do you recommend investing in today's volatile stock markets?
It really depends on risk tolerance, both practical and psychological. So practical, Chris is saying, I got 15 years. What you also want to consider is what other assets do you have? Because if the market investment that you have, if that's it, then you need to balance very carefully between what's in the stock market and what's in less risky stuff. But say that nest egg that you're building is on top of a defined benefit pension, your practical risk is quite a bit lower. The second is psychological risk. And this has been tested like no time before, right? Like you look at the declines that we saw through late March and early April, and if you could not sleep at night, you may have too much exposure to the stock market. If you're like, whatever, 15 years, it's totally fine, then you probably have a reasonably high psychological tolerance for risk. So really the holy trinity of investing over long periods of time, and I'd call 15 years a long period of time, is diversification by region, by asset class, by industry. Second is low fees. Make sure that you're not paying a whole lot of money for the investments that you have. And third is to be regular, to be contributing regularly. If you're someone who's paid every month, be contributing every month in periods of great stock market performance and periods of terrible stock market performance, because with what's called dollar cost averaging, you're going to get the best price for those stocks as you continue to invest. 15 years is a reasonably long time horizon. As you get closer to needing the money, you're tweaking the levers here, reducing the amount that you've got that's in higher risk stock markets and increasing the amount that's in lower risk fixed income or bonds.
Okay, that is good. That is thorough. We appreciate that, Bruce. Thank you.